Welcome back to NASDAQ Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at NASDAQ. We're coming to you live from Vegas at the Global EQ Derivatives Conference. Joining me for this segment, we have Dominic Poloni. He is the CEO of IPS Strategic Capital. We're going to take a look at long vol strategies. Dominic, it's great to see you again.
Yes, Jill.
And I'm excited for this conversation because short vol has kind of been the trend, which works till it doesn't work anymore, as we have seen. So let's learn more about what you're doing at IPS with long vol.
The one I'd like to talk about is our IPS bear strategy. What's interesting about bear strategies is if you think about some of the big bear mutual funds, Hoosman, the prudent bear, they have a very, very negative carry in an up market. The market could be up 10, they might be down 10. They're using essentially a short future strategy. Most other people hedge, they use essentially maybe some type of a 60-40 stock bond mix. They're using debt. Hopefully that debt will go up when the market goes down. They're hoping that the covariances hold. We as an option house, we don't. We actually use a protective put strategy. And a lot of people say you can't use protective puts as an effective hedge. The carry's too expensive. It might cost you 8 to 10, 12% to protect a portfolio over a 12-month period, and that would be too much. The market's flat, you're down 10. The market's up 10, you're flat. So how can you use something that was really designed as a defined hedge, but you can use it in a way that can reduce the cost of holding that? Well, I'd like to say I think we figured that out with our bear strategy.
You don't want to try to depend on specific predictions of catalysts for that crisis. It can happen in an hour, or it may take years, all right? But definitely, we are in a precarious situation. I don't know when that malfunctioning plane will crash, but it will eventually crash. So you need some kind of protection from tail hedging that is done intelligently, not like foolishly, or stay out of the financial markets, which is what we recommend people.
All right, so how is that different from traditional put strategies that you were just...
What we're doing is we're essentially able to reduce the cost of holding our long puts, and we do. We don't use VIX to hedge. We don't use volatility to hedge because vol doesn't always respond when the markets drop.
And that's what I want to